Today I'm going to share 5 stocks that just announced dividend raises this week. Some of these are iconic American businesses like McDonald's, and others come from companies you have likely never heard of, but may be worth keeping your eye on. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Please sign up for my free email newsletter if you want help finding better dividend stocks. Every Monday you'll get the most important dividend news, whether it's increases or dividend cuts. Link in the description and pinned comment. Stock number 1 is Honeywell, ticker symbol HON. Honeywell declared a $1.13 per share quarterly dividend, which is a 4.6% increase from the prior dividend. Now, Honeywell is a global industrial conglomerate. This is a company which has grown at a reliable rate over the past few decades, and the stock price has largely followed the increase in earnings per share. However, it seems like growth is slowing at Honeywell. Revenue per share has only grown at a 1.08% 10-year compound annual growth rate. Net income per share has fared a tad bit better at a 5.51% 10-year CAGR. Free cash flow per share peaked in 2019 and has not since recovered to those levels. In fact, it has continually declined year after year. Despite that, the Honeywell dividend continues to grow on an annual basis. The 10-year compound annual growth rate of the dividend is 10.17%. However, over the long term, the dividend will correlate to the growth of earnings. However, over the long term, the growth of the dividend will start to trend towards the growth of both earnings and free cash flow. That's why the 5-year compound annual growth rate of the dividend is down to 4.66%, and the most recent dividend increase was 4.63%. This puts Honeywell's forward-looking annual dividend payment at $4.52, which is a 2.18% dividend yield. Now, luckily for Honeywell investors, the dividend is still sustainable. Based on free cash flow, the 2023 payout ratio of the dividend is 66%. However, this has been rising since 2019, and that's because they've been increasing the dividend, but Honeywell has not yet seen a rise in free cash flow to keep up with that. And the payout ratio based on net income currently sits at 50%. So the Honeywell dividend payment is less sustainable and lower yielding than it was a decade ago. And a company's dividend policy is often predictive of how they think the company will fare in the coming year. And this 4.6% increase is a continuing slowing of dividend growth. And it actually makes me start to question other parts of Honeywell stock. For example, the earnings of Wall Street analysts seem way too bullish. They are projecting annual EPS growth north of 10% over the next 4 years. And based on the recent performance and the company's dividend policy, I would not think this is likely, especially when you consider that we are looking at those stats on a per share basis, and the company has continually bought back shares at a high rate, decreasing their shares outstanding. So in these years of low revenue and earnings per share growth, they were kind of juicing the stats with share repurchases. And you can see that revenue has actually declined significantly in that time. Operating income has barely grown at all. So I am not very confident in the projections of Wall Street analysts for this stock. And that would also lead me to be dubious of their price target as well. The consensus price target among Wall Street analysts is $224.56. Based on that, the stock is 8% undervalued at current prices. That said, I do not think Honeywell stock is cheap or presents an obvious buying opportunity at the moment. Stock number 2, I have Accenture, ticker symbol ACN. They just declared a $1.48 per share quarterly dividend, which is a 14.7% increase from the prior dividend payment. I recently did a stock analysis video on Accenture where I dive more into their business model, but what you mainly need to know is that they are a consulting company. But this is not just business consulting, they focus on technology solutions, and Accenture very much so is a technology company. And over the past decade, Accenture stock has grown earnings per share at a high rate, leading to ample stock price appreciation. The 5-year compound annual growth rate of revenue per share is 8.82%, net income per share is growing at a 5-year compound annual growth rate of 9.55%, and free cash flow per share is growing at a 7.75% 5-year CAGR. And that's off of a weak fiscal 2024 where they had a 3% decline. If we look at Accenture's dividend payment, it is growing fast. The 5-year compound annual growth rate is 13%. The most recent dividend increase was 14.73%, and this is consistent with the 2 prior being at 15% each. And although it may not initially look like it, Accenture has a history as a dividend growth stock. They were growing it at an annual basis while they were an annual dividend payer, and then they switched to being a semi-annual dividend payer. And in 2019, ultimately, they switched to being a quarterly dividend payer. And you can get this most recent dividend payment if you buy the stock before October 10th. With the dividend increase, the new forward-looking annual dividend is $5.92, which gives it a 1.69% dividend yield. And the Accenture dividend is sustainable as well. The payout ratio based on free cash flow currently sits at 37% and 43% based on earnings per share. and it is consistently in this 25 to 40% range. And of the stocks that I'm sharing today, Accenture is the most likely that I would add to my portfolio. Wall Street analysts are projecting double-digit earnings per share growth over the next 4 years, and unlike Honeywell, I think this is actually going to happen with Accenture, and the consensus price target among Wall Street analysts is $376.62. That would make the stock 7.7% undervalued based on current prices, so it's not a screaming discount by any means, but it definitely is a high-quality dividend growth stock. Stock number 3 is Concentrix, ticker symbol CNXC. Concentrix just declared a 33-cent per share quarterly dividend, which is a 10% increase from the prior dividend. Now, this is a company I had never heard of before. However, as I was preparing for this video, I decided to include it because it did look like an interesting opportunity. Concentrix is a technology company, and they went public in 2020, and since fiscal 2022, the stock has plummeted. However, what I found interesting is that the company is highly profitable. I mean, you can see that they have positive and growing earnings per share, and it trades at a pretty cheap valuation right now. In fiscal 2023, they generated just under $500 million in free cash flow. The company is currently only valued at $3.35 billion. That means it's trading at just under 7 times free cash flow. And if we look at their free cash flow per share, you can see that this is consistent and slowly growing. And this is kind of a sleeper dividend growth stock as well. The 3-year compound annual growth rate of the dividend is 9.7%. The most recent increase was 9%, with the 2 prior being at 10% each. The forward-looking annual dividend is $1.32, which is a 2.56% dividend yield, but it does this with an extremely sustainable dividend payment. Payout ratio is only 12% based on free cash flow and 20% based on net income. So based purely on the financials, this seems to be a cheap dividend growth stock. However, the problem is that I have no idea what they do as a business. I just learned about this company prior to making the video. That said, even Wall Street analysts think the company is undervalued. The consensus price target is $80, which makes it 55% undervalued at the current price, and they're expecting a large increase in earnings per share through 2027. So let me know in the comments if you think I should do a little bit more of a deep dive into this company. Stock number 4 is McDonald's, ticker symbol MCD. McDonald's just declared a $1.70 per share quarterly dividend payment, which is a 6% increase from the prior dividend. We all know McDonald's, one of the most iconic brands in the world. The stock price has seen fantastic performance over the past decade. In recent history, they have seen a re-acceleration of growth with the 3-year compound annual growth rate of revenue per share at 10.73%. You can start to see this uptrend in their data. Likewise, net income per share is growing at a 22.35% 3-year CAGR. However, based on their quarterly data, this does seem to be slowing down, and fiscal 2024 will likely be down from fiscal 2023. This slowing in fiscal 2024 seems to also be true with free cash flow per share. You can see Q1 and Q2 trending behind Q1 and Q2 of 2023. However, as a long-term investor, you are seeing that growth in McDonald's. This is a consistent dividend payer, increasing their dividend payment on an annual basis over decades. The 10-year compound annual growth rate of the McDonald's dividend is 7.61%. However, I do think this new 6% dividend increase is a notable slowdown. The 2 prior dividend increases were around 10% each. And as I mentioned earlier, these dividend policies are often reflective of how the company is doing right now and expects to do over the coming year. And I think objectively, you are seeing a slight slowdown and decline in fiscal 2024. That said, from a dividend perspective, the McDonald's dividend is still very sustainable. The forward-looking annual dividend payment is $7.08, which gives it a 2.33% dividend yield. The payout ratio based on free cash flow currently sits at 62%, and that will increase likely in fiscal 2024. The payout ratio based on net income is 53% and that will also likely increase. However, it will stay in a sustainable range, and the payout ratio is still nowhere near that 2017 high of 83% for McDonald's. But if you're planning to invest in McDonald's right now, the question you need to be asking is whether right now is the time to buy at all-time high prices. And that comes down to how much you think they'll grow in the coming years. Wall Street analysts have the estimated earnings per share at $11.80 in fiscal 2024, which is a 1.41% increase. And based on how I was diving into the data earlier, I think they'll likely be under this. However, in the following years, analysts have McDonald's growth re-accelerating closer to 10%, around that 8 to 9% range annually. And it's with these estimates that they put the consensus price target at $312.88. That makes the stock 3% undervalued at current prices. McDonald's is a great dividend growth stock, but I don't know if right now is the time to buy. I do think there is risk they could underperform in the upcoming quarters and analyst price targets will come down. You might see a sell-off back around to this $260 range that they were at just a few months back. Stock number 5 is OGE Energy, ticker symbol OGE. They just declared a 42-cent per share quarterly dividend, which was a 0.7% dividend increase. This was a utility company I had not analyzed before, but they currently have a 4.13% dividend yield. Historically, the company has been a reliable dividend payer, like most utilities, which is why some retirees like utilities for consistent dividend payments. However, if you're young, I do think there are far better opportunities for both yield and growth. I mean, you can just look at the stock from 1992 to 2008, the dividend barely increased at all. However, from about 2010 to 2020, they saw much higher dividend growth in that time. That's a little interesting. I would have to dive into why that happened for the company, but the dividend is now slowing down again to those prior levels. This most recent dividend increase of 0.7% is a trend and a slowing trend. The prior dividend increase was 0.99%, and the increase before that was 1%. And with most utilities, the free cash flow based payout ratio is just completely out of whack. It is sustainable based on net income at around an 80% payout ratio. Personally, I like to stay away from slow growth investments like OGE. You'd have to buy incredibly cheap for it to be attractive. So those are 5 dividend increases that just happened over the past week. If you want to use the stock research tool I used throughout the video, then please sign up at dividenddata.com. Also sign up for our free email newsletter where you can get these dividend increases and more in your email inbox every single week. Link in the description and pinned comment. Please leave a like, comment, and subscribe to the channel. See you next time.